Next up, it's Rick Stone. Um, Rick has a very, very interesting group. It's called PBIRG. It's Palm Beach Investment Research Group. So Rick and I have basically done a lot of stuff together over the past, I would say, it's over 10 years now since I initially went to his group. We share a passion for making Florida a great place for alternative investments. Rick has been providing exposure to fund managers, people who have interesting businesses, to a group of family offices in Palm Beach. How many years has it been around? 13 years. So it's been around for 13 years. Had dinner with the former governor, current senator, a decade ago, and it was on the night of the 2014 election, right? So the eve of the election, which I found an interesting time to have dinner with Governor Scott. I thought he could be utilizing that time better than having dinner with us and
his Secret Service detail.
So, but we've been advocating for alternative investments in Florida now for a long time, and that's basically what initially brought us together and has started a friendship. He's very passionate about his investing. He's also a collector of art. He's donated significant collections of art to Florida Atlantic University. He sits on the foundation at FAU as part of their investment committee. But I'm talking for him instead of to him. It's supposed to be talking to him. So, Rick, what got you involved in the art world, and what made you donate some pieces to FAU?
I've been an art collector for about 20 years. Never buying the top premium artists, but sort of second-tier American Impressionists, and then related art around that. And the reason why donation turns out to be a pretty good deal is because it's very difficult to get good prices for second-tier art. You have to go through the authentication process, which is like $2,000 to $5,000 depending on the painting. Sometimes you have to send it to France if the painter was French. There's shipping, there's insurance, and then there's the price to sell, which is anywhere between 10 and 25% depending on where you're selling. So you're basically 35% in the hole in the sale process. When you donate the art, you get an appraisal. And in general, appraisers with respect to art that's for donation are liberal, if that's a fair term. So the difference between the tax benefit that you get from the gift of the art and the sale proceeds you get after tax, and then there's capital gain or ordinary income and sales tax in some jurisdictions, turns out to be nominal. So unless you're selling a very highly appreciated piece of first-tier art, a Basquiat, a Van Gogh, a Matisse, often donation, if you want to dispose of it, is almost equally beneficial. And then the entire community that you're donating to, in this case FAU, has access to that art and whatever acclaim and value there is to being a philanthropist is also associated with that. So I had a collection of American Impressionists. I thought they were good, but hard to sell. And then FAU offered me the opportunity where they would actually display the art, not on a wall, but in a sort of custom-built metal rack, so that students could actually approach the art, come up close to it, see it, photograph it, sketch, things like that, almost, and touch it, so to speak. So their idea was that they would make my collection and future collections really accessible to the students. They have a master's in art history and art curation at the school now.
So he not only is passionate about art, but he's given you a very well
well-rounded economic argument as to why donate your art versus sell it in the secondary market, which it's very efficient from a tax write-off perspective. But don't tell that to the 87,000 new IRS agents
Right, exactly.
that have been hired, okay? Keep that quiet, please.
I mean, it is a process. You do have to have an appraisal. The appraiser has to be IRS approved. There's restrictions on what they can do with the art, but there's a little bit of a learning curve. But once you've done that, it's pretty simple.
And there's one other thing, is a 1-year holding period in order to donate the art, correct?
Right.
So you have to have it in your possession for at least 1 year before you can gift it, right? But you can gift a lot of different things, like baseball cards, right? For instance, and that may, if you buy it right, give you a 50x return on your donation, right? So, Rick, you've been involved in, direct investments into businesses. You've done real estate. You built your dream home. You sold your dream home for $40 million at the beginning of this year. What do you think of Palm Beach real estate prices and where that's going to be heading in 2023?
So I think there are very few super high-end real estate markets. Palm Beach is one of them. Boca/Fort Lauderdale, Miami, Beverly Hills, Los Angeles, and the Hamptons basically covers the super luxury market. Palm Beach is a little bit more unique than those markets because it's such a small market. Really, there's only 3,000 houses in total and condominiums in that entire marketplace. So it's hard to sort of get good statistics around that. But the prices in Palm Beach are so aberrational compared to the rest of the country that it's hard to believe that they can continue to go up. I actually sold a house in Palm Beach at a price that I thought was aberrational, and then it went up another 50%. And it's now starting to level off. But I do think that the high-end market is changed dramatically. The high-end market, in my opinion, is dependent upon several factors. One is wealth creation. So during the COVID period, you had a massive wealth creation. You had crypto people. You had companies going public at ridiculous multiples to revenue. I'm going to talk about that a little bit more, that have come down to, not reality, but have come down quite a bit. And then you had a huge amount of banking revenue from trading bonds and things like that. So you created more wealthy people above $50 million in that time period than any other period in history, according to our statistics. That drove the high-end real estate market because those people were converting money that was equity in a speculative company like Carvana that might never be profitable, that looked palatable in the marketplace during the virus, but now is down, according to our numbers, $83 billion in market cap in the last 9 months, and convert that into a physical asset. A mansion in the north end of Palm Beach, a giant condo on the top of a 60-story tower in the Porsche building, and that's what people did. So that market was driven by immense high-end wealth creation. I don't see that happening again. Right now, somebody gave the statistics, S&P down, 17, NASDAQ down 28, 30, private equity probably down 50, although the marks, as he said, haven't been taken in the market. In our private equity portfolio, on the places where I sit on the investment committee, they haven't taken any marks, some of the managers. So we're looking to the near future where those will be marked down 50%. And that's going to be dramatic because we all know that last year, large institutional money from universities, Washington University in St. Louis, Duke, Dartmouth, were 50 to 70% up years. And it's likely that they'll be down, not quite that much, but 30 to 40 this year, certainly in the private equity portfolio, and across the whole portfolio, maybe 30. So we're on the flip side of that. Without massive wealth creation, the high-end real estate market can't exist. Interest rates do affect the high-end real estate market, but not dramatically because it's almost all cash buyers, but not exclusively. 20% are not cash buyers. But there's another factor that people are considering, and that's inflation. The cost of operating a high-end house, I could use mine as an example, is probably up 20%. And I actually see this as a canary in the coal mine. I've been doing a survey of the increase that's going to take place this year, fiscal year 2022 and fiscal year 2023, in gated communities, HOAs, and condominiums across South Florida. So I moved from the house that you described to a large condominium in Palm Beach Gardens. My HOA fees are going up 40%. And that's a function of two things. One, general inflation. It's a high service building. We have valet, we have doorman, we have concierge. All that's going up. The service companies are marking up. And second, insurance. For most buildings, you're going to see a doubling in the price of insurance due to the hurricane, due to the collapse of the building in Fort Lauderdale. And unfortunately, in Florida, you've got to carry insurance. So that is going to dramatically increase. I've heard numbers anywhere from 20% for lower service HOAs to 50% for the super high-end HOAs, like ones in Palm Beach Gardens and Boca Raton. So that's also going to change the market dramatically. For those people, a lot of those are financed, so they're going to have higher mortgages. Some of them did buy adjustables. 2, much higher HOA fees. And 3, a declining market in terms of price. So do people really want to hold on to property that's flat to down, where their costs are going up 30 or 40%? Maybe, but maybe they can't afford that. So I think there's going to be a heavy weight on the Florida high-end to almost high-end real estate market. And I think super high-end houses are going to become hard to sell like they were 10 years ago. I'm old enough to remember that 10 years ago, the mantra in real estate was no one wants a giant second house. And the generations after me don't even want houses. They're going to be moving around in Uber, and they're going to do Airbnb and rentals, and they're not going to have physical premises anymore. I'm not saying we're going to return to that, but it was way too much high-end construction. You drive down A1A, and you see 16,000 to 20,000 foot houses that I think are going to become dinosaurs. And I don't think that's going to turn around that quickly. This was aberrational in the last few years because of COVID. And then my main argument for that is the $7 trillion that was pumped into the system that increased the money supply through PPP, through bond buying, through the TALF programs, through asset purchases. That money caused the greatest asset inflation bubble ever, bigger than the Japanese asset inflation bubble. And part of that was house prices. Part of that was watches. I don't know if you're wearing your watch today.
I'm wearing
okay. So my own watch, which I never wear,
Fitbit.
went from 21,000 to 120,000 during that time period in terms of pricing on internet websites. That's not realistic, but there was so much asset inflation and so much money put into the system that people were buying those assets. Among that, high-end cars, watches, high-end houses. So I think that's a bubble that hasn't burst, but will burst. And it's not so much directly related to interest rates. It's all of those factors combined. And right now, I think the gentleman before me said there's a stalemate. Nothing's selling. Some high-end houses are starting to sell, and I follow sort of the Wall Street Journal every week does its House of the Week and its House of the Month, and you're seeing 20 to 30% discounts off of offering prices routinely in the Northeast now. And I think that's going to happen down there, even though the demographics are still favorable for Florida.
All right. So this has been a very large macroeconomic discussion historically. So first, we're going to go top down. What do you see for 2023 as the biggest risk for asset prices?
I mean, I don't think that the stock market is correctly valuing the decline in profits that's occurring and will continue to occur. Again, the $7 trillion that was created in the 2-year period of COVID is still out there. I mean, it didn't go to money heaven yet. And yes, people are spending down that money and they're using it, but it's going to take much longer for the impact of higher interest rates and job destruction to re-regulate the economy than before, because we never had a circumstance where we increased M2 like we did this time. And I think the smart economists are now saying that all the stimulus was a huge mistake, and that the asset bubble it created really only benefited rich people. But they're also saying that it's going to take much longer to fix. And I agree with that. I mean, there are lots of people that still have PPP money that are spending it. Restaurants are not empty, as you would expect in a pre-recession or near-recession economy, and people are still spending, but that was the funny money that was created. So I don't think we've seen the bottom of the bottom. I think it's going to take quite a bit longer, like late 2023.
So, Bob Elliott from Unlimited Funds earlier today basically said that the U.S. economy is in good shape. It's been creating jobs at a pace that it's seen almost for the entire year. The growth is still there. It has obviously slowed a little bit, and we've had some negative prints, but we still are a growing economy. But as Aman was saying in the last presentation, the NASDAQ, the S&P, the Dow Jones Industrial Averages are down, 17, 25, 28% for the year. Do you think that perhaps those asset prices being down are a result of higher interest rates with Fed funds and the discounting mechanism that goes into valuing stocks?
I mean, mathematically, that's a certainty, right? If you're doing discounting and efficient frontier math, higher interest rates are going to lead to lower stock prices. I don't think the economy has crashed yet. I agree with him, but I don't think that's a function of the economy itself. I think it's a function of having put so much money into the economy that's not been spent yet, and that will get spent down. In terms of the job thing, what I think we're seeing is high-end jobs are disappearing. Low-end jobs are still being created at the same level they were before. Low-end service jobs, which are paying not minimum wage, but a little bit above minimum wage. But we're seeing tech. We're going to start seeing banking. When they stop paying after the bonuses are bad this year, we're going to see layoffs in that business and people leaving in that business. So
Did you see Goldman Sachs' warning this
I
morning?
did, yeah.
Goldman Sachs, for those of you that haven't been reading the Wall Street Journal today, is issuing a warning to their traders saying don't count on fat bonuses this year. What did that tell you?
That's reality, is that they're seeing the future as not being very profitable. I mean, they made a lot of money trading bonds. That's what saved the firms, right? There was a huge swing in bond trading, but deal making, M&A, advisory are all way down and will continue down. There are some deals that are occurring, but they're in the biggest area of deal making we're seeing is in zombie companies. These guys just won't die. It's like that movie where the people just keep coming back. So you have zombie companies that were never profitable, don't have a business model that's likely to be profitable, did have growing revenue during COVID, have flat revenue now, and they go into the marketplace and doing the craziest nonsense that is just going to lead to more liability, where they're offering stock slightly below market and then warrants if it goes down further. It's an incentive to take the stock down. I am involved in a company right now that the stock went public at 21, which was a $9 billion market cap. The stock is now 60 cents, 58 cents this morning, which is a $200 million market cap. They have lost $1 billion in 3 years. It was not affected by COVID very much. It wasn't that kind of stock. It just was a bad business model. And they are going to do an at-the-market offering and dilute all current stockholders 300%. So the stock's going to go to 15 cents. This was their plan.
It sounds like a death spiral.
The death spiral, exactly. And then the SEC didn't approve it. But we're at that level now where
We're not going to mention any companies.
we're not going to mention any names.
No names.
So this is a kind of a interesting thing, because everybody says, when are the zombie companies actually going to die? The 1,000 companies that were never profitable, never will be profitable, burned through all their money, have done second rounds, and now we're in a higher interest rate market and where it's hard to raise equity capital. Okay, will they die? Well, they will die, but they're not going to die quickly, and they're not going to die easily. They're going to think of any scheme, any possible way of getting just enough cash to stay afloat, to pay themselves salary, to pay themselves bonuses, but all that's going to end within a year. And I think that's when the distress cycle starts. I myself put money in distress 8 months ago, didn't even call any money. They're starting to return money. And these are really experienced distressed guys at the smaller end. And they said, we anticipated zombie company failure, but we were wrong. it could be another year. And that's because of the sort of these machinations of at the market offerings a little below the market with warrants that are effectively below market offerings. And I think we'll continue to see that. The SEC is behind the curve on this and sort of monitoring this and evaluating this. But we're going to see that. And I brought with me sort of a cheat sheet where not only is there zombie companies, but there are examples of companies who had a completely invalid or nearly invalid market model and were driven up during the COVID cycle based upon hype and are now starting to approach reality.
Is
So
Carvana number one on the list?
it's not number one on the list because it's the worst. It's number one on the list because it's alphabetical. But no, it's fairly random. I mean, we sort of went through and then we picked names that people would know. So Carvana's market loss from the high to today, which is all within 2 years, is $84 billion. I mean, who would ever think that that company could be worth $84 billion?
I
No,
did.
You did.
I did, absolutely. I thought that it was worth that and that you should start up like-minded companies
Really?
if you're the actual sponsor.
Okay, I'm not going to answer
Not
any
the
more of your
investor.
questions today.
Not the investor. But I had a little edge in that space. So I was.
Peloton. Now, everybody, like when Peloton came out, I go to the gym and there's lots of options on bicycles and recumbents and all of that, and they all have little movies on them, or the Swiss Alps, or attractive young people telling you how to ride the bicycle, and $79.2 billion market cap loss. So when you think back to people saying this is like the NASDAQ crash, it's nothing like the NASDAQ crash. Companies were worth $1 billion.
One company's as big as the entire
Correct.
.com bust.
Correct.
Right?
When you count in the losses in these companies and the loss in the bond market, on average 15 to 17%, depending if it's domestic or foreign, the total market loss across debt and equity swamps any other period in history, because we haven't had a bond market loss since 1980. So when you add in that, and the bond market's 3 times bigger than the equity market, the amount of actual loss in investment assets is the greatest in history. Zoom, everybody's favorite.
What about the $2 trillion in crypto that's wiped out?
We're going to come to that. Zoom, $174 million market cap loss from high to now.
170 billion?
174 billion
174
loss
billion.
in market cap. PayPal.
3 times the size of the .com bust.
By the way, I didn't use PayPal until recently. I run a program for aspiring tennis players, and they're always traveling. So they said, "Oh, you got to PayPal us money." I said, "No, I give you checks or cash you deposit." They said, "That's not how it works. You PayPal money. Some of them cash out." Every time I did PayPal, by the 3rd time I did PayPal to that tennis player, they stopped me. They said, "There's something wrong with this account. We're not transferring it anymore." And to get back on PayPal, I had to give them a blood sample. It was insane. Not only did I not understand how the business model worked, I didn't understand how everybody could use PayPal and not be insane. And then I found the website We Hate PayPal, or pardon me, FU PayPal, with 500,000 members, and I understood what this was about. So that's a company whose market cap's down by $400 billion.
Wow.
I mean, when you look at these numbers, and it's a couple of $1 trillion, and I only have the top 10, it's astronomical that the impact hasn't been greater. I mean, my sort of main theme is, why aren't more people jumping? And I don't mean physically jumping, but why aren't more people saying, "Holy cow, this is a colossal, almost depression-like market. It's nothing like NASDAQ." And I think, again, it's because of the stimulus money still being out there. Just a couple other examples. SoFi was going to be the future of banking, of course. We didn't need JP Morgan or Morgan Stanley anymore. Everything's going to be online. They're only high-end. $24 billion market cap loss. The stock's gone from 25 to less than 4. Still have never made money in the decade that they've existed. Blue Apron. I know no one knows how to actually shop anymore. It's not that hard. They need everything cut up in little portions and delivered to them. A little bit odd. Market loss of $14 billion. How can a home delivery company that sends you little pieces of salmon cut up in bite-sized portions and and salt and pepper lose that much in market cap? How could it ever have gotten that big? So our sort of perspective on this is this was an aberrational period in market valuation driven by tremendous amount of increase in money supply and excess liquidity. That led to an asset bubble in stocks and in physical assets, high-end housing, watches, boats, high-end cars. And we haven't seen anything approaching the demise of that. We've seen asset value destruction, but we haven't seen the consequence of that yet. And there is a responsible party, and that's the Fed is responsible for this. And they're trying to fix this now through what they're doing, but I don't think that works. And the sort of unfair part of it is that very wealthy people that promoted these stocks, insiders, or that bought these stocks, or that owned physical assets they were able to sell during that compressed time period, became immensely richer. Again, I've seen several studies which show that the largest number of people owning $50 million in assets was created in that 2 years than any other period in history by far. So that is really sort of a socio-economic consequence of this that was maybe not predictable, obvious, but that was the result. So again, we don't think we're anywhere near the end of that. What we think is we're headed into a cycle where investing may become easier. By that I mean, I think corporate bonds will be yielding 8 and 9% for a long period of time. Junk, I think, is overpriced now, but near junk, maybe 10, 11. Middle market lending to companies that aren't bankable, 12, 13, 14, even 15. And so without doing a lot of hard work, you may be able to play in a part of the market that we didn't play in, the debt side of the market. Okay, we're all equity investors for the last 20 years as rates were coming off. Now, if we're in a stable, sort of higher market, maybe declining a little bit over time as we get recessionary, you may be able to get high single digits, low teens through conservative debt investing, which is perfectly fine for endowments, which are tax free. Your IRA, your 401k, your defined benefit plan. And that may be a big part of the investment that we at our group in alts are going to be looking at going forward. And actually, we've started that. We're starting to see the sort of a little bit more adventurous middle market lenders coming to us with deals that are 15 to 17% and reasonable and not far out on the pricing spectrum or too illiberal. So we think that's a good avenue. The fellow spoke about secondary funds. Yes, I think secondary funds have a good opportunity, but everybody knows that. And there's just a lot of money in secondary funds now. So what seem like fairly steep discounts are not steep discounts. There are some secondary funds that are a little bit more sophisticated. So they're buying insider stock from insiders who realize that their companies are overvalued and they were worth $100 million and lived in their country club in Beverly Hills, and now they're worth 40 million, and they want to keep that 40, so they're willing to sell at a discount just to get out to know that they've locked in dollars. So that's a big part of the market right now for secondary funds, not the traditional buying a seasoned pool. We think those are the only areas where we sort of see bright opportunity. You asked about crypto. I'm not an expert on crypto. I'm a securities lawyer, and I teach securities law, but I'm not an expert on crypto, and that was deliberate. I never felt that it was an asset class that was going to be worth my time. We've had 700 presenters at our investment group, Palm Beach Investment Research Group, not one crypto investor. We have had people talking about blockchain and the future of blockchain, and it's always the future of blockchain because we really haven't seen the impact of blockchain. I mean, they came and talked about blockchain, and everyone in the group said the same thing. Why aren't titles for houses on the blockchain? Why do we have title? Why am I paying, 75 basis points for title insurance on a house that I bought, and the guy I bought a year ago and had a title policy? Nothing happened in that interim period. Okay, there was no mortgage, there was no lien. Why do I have to pay the same thing again? That seemed like a perfect, but no movement has been made to do that. So it may be that blockchain is the panacea that people think it is, but I haven't seen it. But crypto, I think, is an ill thought out, unregulated, and surprisingly unregulated form of investment. Whether it's a security or a commodity or a hybrid or none, under federal law, and there are different results under state law, which some have broader definitions of what is a security, isn't to me the issue. The issue is you can't have a system where the trading vehicle, the exchange, the New York Stock Exchange of crypto, isn't regulated sufficiently so that customer assets are segregated and audited on a regular monthly basis, like focus reports for brokers. Absent that, nobody knows where their money is, and we just saw that in FTX. So I was in this room on Monday, with a young man who was a crypto promoter. At least that's what I called him. He denied that, but he was working on an ETF for crypto, and they got it through the SEC, but it's not quite there. And his position was Bankman and FTX are just like a historical artifact. These things happen. These things don't happen. There has been a failure of the Boston Stock Exchange Clearing Corporation went out of business in the 1990s, but it was tiny. It cleared for lots of penny stockbrokers, and one penny stockbroker went broke. There was a short squeeze. The stock went from 0 to 10 cents to $100. They were left holding the bag for that when the firm sold, but it was a minor player. It wasn't the New York Stock Exchange Clearing Corporation. It wasn't DTCC. So what we know now is that there was no regulation of this exchange, that customer assets were commingled with assets, and that the underlying value of the exchange was a self-underwritten currency, its own coin. That could occur offshore is striking, but not crazy. Hopefully that could never occur in a domestic exchange. But what's most striking to me about FTX is that large institutional players, and again, I won't mention names, but they're easy to find, would invest in an exchange located in Antigua and Barbuda. So the last time Antigua and Barbuda entered the common parlance of exchange was with another Ponzi scheme, and that was called Alan Stanford. Second largest Ponzi scheme in U.S. history, $10 billion disappeared. And that was clearly the result, because I litigated that case, of bribery of local officials and spending lots of money in Antigua and Barbuda, building soccer stadiums, taking people out to fancy dinners. You had private planes. It was a traditional graft system. And of that $10 billion, very unlike Madoff, where a lot of the money was recovered, almost 50%, 10% has been recovered in Stanford because he paid it to himself, he wasted it, he bought bad assets, and he bribed people. And there wasn't any assets left to get, and there weren't third parties to sue. So the notion that these major players didn't know that Antigua and Barbuda is known primarily for being a fraudulent investment locale, and I don't want to say anything personally about this individual, Sam Bankman. I'm sure he's on the Mensa scale 50 times higher than me, but he doesn't come across as someone that I would give billions of dollars to. He doesn't come, and an exchange is not necessarily a complex business that you need an MIT math degree to run, but it's very complex in terms of there's lots of transactions you have to be accounted for. You have to know where your positions are. You have to know where the fails are, and he just didn't seem to have the architecture for that at all. So whatever due diligence was done and wasn't done, it seems more like it wasn't done. And your friend from the SALT conference was on TV saying you can only do so much due diligence. It's just hard for me to believe that they physically went there, looked at the operation, and said, yep, that looks a lot like the New York Stock Exchange and DTC to me. I'm going to go with them people.
So why would somebody sophisticated, like some of these investors inside of FTX, put money in if they didn't have the proper oversights and controls?
Fantastic question, and will be a book, I'm sure, soon, and probably a movie. But it's unfathomable. And I think that's why we have this sort of dead silence about this, because people are sitting back and saying, like, how did I do that? How did I give this guy with no infrastructure? I mean,
So
This is a-
how
this
do
is
you
a-
think
have you
they
ever-
convince
have you-
themselves to do
Have
it?
you ever been to, like, the back office at DTC and how many people are there? There's millions of files every day that have to get corrected. The phone call. It's a complex people-to-people, labor-intensive business. There was nothing like that there. Um, and I don't know. I think my personal opinion on this is this crypto has become, don't take this wrong, like a religion. People believe in it without questioning its fundamental value, or its fundamental importance, or its fundamental accuracy or truth. And so when this guy here was telling me, no, that there's nothing, FTX was nothing wrong with that. So what that an exchange failed? So what that they used their own coin to support? So what that they were paying Phantom 12%? I mean, first of all, how could anybody in a zero interest rate environment think that you could get 12% on an account? Believe me, I had a lot of friends, younger people, that did that. And
It sounded reasonable.
how did it sound reasonable?
All right, so I'll give you a story. So there was a gentleman that was going around saying he basically would give back 20%. He would give back 80% of what was traditionally earned through the stock lend, but instead of stock lend, it was crypto lend.
But stock lend margins are tiny compared to this crypto. And that's an established system
But
with real players and monitoring.
It was a plausible.
It's plausible that you
explanation.
could do lend, but not at those rates.
So I mean, look, I have to admit, a year ago, I was buying crypto every single day, a significant amount of it, and I thought I was being responsible. I was dollar cost averaging into the positions, and I lost like 85% of that money. So I was one of those people that bought in and drank the Kool-Aid, and I got Ponzi'd in crypto too.
I mean,
Like,
what's
I'm one of
what
the people who got Ponzi'd, right? Like,
I think crypto demonstrates a lot of things. One, that the market was without traditional means of due diligence and analysis during this time period. Asset bubble, crypto existing in an unregulated market. And you think about it, we have the SEC, with the CFTC, with the FTC, we have federal prosecutors. How could it be that somebody could come up with a new form of money, which is what crypto is, and stablecoin, and no one said, before you trade that new money, we need to establish a regulatory framework for that new money. Is it cash? Is it a security? Is it a commodity? Is it the Loch Ness Monster? Which of these four is it? And this is the regulatory scheme. Let's get through Congress, a scheme, 34 Act for crypto or something like that. Then we can all trade because we're on the same basis then now. We'll know what this thing is, how it trades and settles, where it trades and settles, where the books and records are kept, and what the penalties are for lying about it. The other thing about crypto that always struck me is the market is, for a long period of time, was so small that it was easy to manipulate. I mean, obviously, we see manipulation of the gold market, LIBOR, giant financial markets. This was, not even $1 trillion a year ago. That would be an easy market for anyone to manipulate, especially since there isn't a central clearing mechanism where you can sort of see the trades lined up. The person who has all of the information with respect to settlement obviously has an informational advantage that no one else has. So that always struck me as another problem with that. So it is a little shocking. I mean, COVID was happening and people were dying, and the regulatory environment took second seat to that. But that people at the SEC, including the former chairman who works at a crypto firm right now, and another commissioner, female commissioner whose name I won't mention, but there's only one, and we're so pro crypto without a regulatory system. Yet they go after Goldman Sachs because they use Twitter to communicate instead of recorded emails. That just struck me as fundamentally insane. You have a completely unregulated competitor to the US dollar, and you're worried about whether Goldman guys are communicating contemporaneously on systems other than those which are recorded internally. Not that they committed any fraud, no one alleged that. It was just the use of that system rather than recorded email or recorded text. So that they didn't focus on that, I think is fundamental failure, maybe not the biggest regulatory failure, but one of them that I've ever seen.
So I'd like to, introduce everybody to Forbes, a member of FLAIA. We have the head of the financial services group inside Forbes, the main partner there, and he's here with us. I'd like to thank them for being members of FLAIA. And if you don't know Rob and Brenda, please introduce yourselves, get to know them. So Avita was telling me the other day about TradFi, right? I'm like, what is that? What is TradFi? Traditional finance. So you would definitely fit into the bucket of traditional finance.
Well, that's like a young person's derogatory term for TradFi.
It is. It's an insult. It's being insulted a little bit, right? It's got like a negative cut to it. So, but this year here, it seems to be back in favor, right? Joel, what do you think? Do you think traditional finance is back in favor? So, in one breath, a person like me is being told by a
Deny, is that a term that you use, TradFi? Okay.
I never heard of it either until Avita told me about it, and I look at it as a term of endearment, to be honest with you, right? Like, but last year the pressure that I felt was 30-year-olds like out earning me, right? Doing absolutely nothing, adding absolutely no value, right? And just making more money, right? So there's definitely like pressure on TradFis to catch up, right?
I mean, I think the reaction to, there were two main movements taking place. The crypto movement and the ESG movement were occurring at the same time. Those are two things that I didn't study in business school or law school, that seemed to me to be fundamentally without a rule book, and without a playbook. And both of them went very far. I mean, you had BlackRock being, they were the kings of ESG and ETFs and mutual funds and business sectors and commercials on TV. And now you have the pushback against ETF. Today's biggest pushback against ETF, what did our governor do? He took money away from BlackRock, sorry, today, because he said, if you're going to pursue an ESG agenda that we don't think is necessarily consistent with best investment returns, we're not going to give you money. Texas doing the same thing. So the conservative-run states are mounting an anti-ESG movement now, and the Labor Department is mounting a pro-ESG movement now. So there's a very big fight between whether or not ESG is a legitimate movement that can be factored into investment decisions or hype. My own opinion is I'm very pro-environmental. I've spent millions of dollars on environmental causes in my philanthropy life. Social, I'm very much promoting minority interests, the rights of women, et cetera, et cetera. Governance, I think we have pretty good corporate governance. The Delaware Code seems to work better than most other countries' system of corporate governance. But people who are investing are in the business of making money for shareholders. And they can't be promoting their own personal view of what's appropriate in society or their own personal view of what's appropriate in environmental technology to the exclusion of just making money for investors. They can be factors, but the predominant interest has to be making money because they're not politicians, and I'm not giving them authority to make political decisions, just making money decisions. So it's sort of like crypto in the sense that both of these big social trends and economic trends occurred without a clear rule book. You know what the rules of corporations are in the state of Delaware? I can show you them. It's Delaware Corporate Code. It's 80 pages, and there's lots of cases interpreting it. I can tell you what's a breach of fiduciary duty and what's not with a high level of certainty. I have no idea what's appropriate ESG. I'm honestly involved in a case now suing a company who said that they're ESG and that they're humane and ethical, and they're inhumane and unethical beyond belief, and more than I even imagined. So and they sell their product at a 20% premium to similar products based upon ESG street cred. So to me, is it a lot of hype? In some cases, it's a lot of hype. And then, of course, there's an economic decision, which is what makes sense from the environmental perspective when there is a shortage of carbon fuels. So if we don't have enough carbon fuels and we can't fill that in with non-carbon fuels, water, wind power, nuclear, should we do more carbon or should we freeze? Most people can say do more carbon. So that economic decision isn't a question of social policy, it's a question of economics. Who's going to suffer for that? And we're there now. So 1 week we're angry with the Saudis and we're going to discontinue relations. And the next week we're begging for oil. So that's the problem with developing an economic social policy without a rule book. Democracy developed over 250 years. ESG developed in 2 years. The first ESG movement was actually the anti-South Africa pro-Nelson Mandela movement, if you sort of study the history of it. But it laid fallow for a long period of time. That was really the only international ESG movement for a long period of time.
So we have a question here from Rob, or a statement. Rob, here's a mic right here. If you could just talk into it so the 875 people virtually can hear you.
Thanks, Mike.
There's over 100,000 minutes of live review time today. So,
Rob Cullery here. With the presentation, just on this topic of ESG and the Florida decision, looking at this objective, I have no sort of conflict with this, but a lot of these institutions have to also address the needs and preferences of these institutional limited partners who want to see ESG as part of who's on the other side of the table. That was just one thought, and I think the other thought, to your point about the rule book, if you take things like aerospace and defense, that was viewed as anti-ESG, and then Russia-Ukraine happened, aerospace and defense became fitting, needed, defense stocks went up. So I think some of your energy and ideas might be towards how do we develop this rule book, because I think you said your point, your environmental, you support causes. But there's got to be an interesting balance there versus just this complete turn off the spigot, because that's a big number for black. That's a big number, but BlackRock's probably not sweating it that hard. And, they're going to stick to their guns. And there's also this longer term value of, hey, we're sticking to this interest of ESG mandates. So just want to bring that up and see if you had some.
No, I think they are sweating it hard because their concern is that other red states are going to do the same thing. And so it's not going to end their business, but the best money to have is state money. I mean, it's the biggest. When you get it, it's sticky, and they're large pools, and they're not investing typically in esoteric things. They're investing in your mainstream funds where you have high premium. So, no, I think they're worried about the Florida, Texas, united anti-ESG movement, and it's nowhere. It's really just beginning.
Just one last thought is that they also get the more allocation from blue states, or they from Europe and these other places that are big supporters of this, for these developing financial institutions. Fair enough.
I mean, we don't. I mean, my own opinion is we don't want to turn economic development into a political fight. I mean, that's a mistake, because then you're going to have very divergent results dependent upon the state you live in and its view of ESG. We're one, economic union, and we ought to have a set of policies. And setting up a fight between the Department of Labor and Texas and Florida seems to me to be no winners there.
So interestingly enough, Gina Raimundo is she's Secretary of Labor, right? Commerce. She's a Rhode Island governor. She went to the same high school as me, and her policies were terrible in Rhode Island. Now I guess they're bad in D.C. I don't know that for sure, but anyway, yes.
Yeah, isn't there a countervailing problem though with states? Oh,
Sorry, Dual. I'll get right back.
I
to
can
you.
talk louder.
There's a virtual audience that's.
Isn't there another issue though with states starting to use their political positions to push companies to do different things than the companies themselves want. In other words, you've got the case of Disney here in Florida. If a company wants to do ESG, okay, fine, you don't have to do business with them, but politically punishing them is kind of a whole different thing.
I mean, I agree with you. We don't want to turn economic opportunity and growth into a political set of decisions. I agree with you on that. The governor of Florida and Texas feel that they are fighting a battle against companies that are not looking out for shareholder interests. Simple as that, but are looking out for their personal points of view on ESG.
Right.
I'm not saying that's right or wrong, but that's a very realistic
Right, but is that
political
up to the
battle.
government, whether a company is looking after shareholders?
No, I
That's up to the company. And shareholders won't invest if they're not taking care of the shareholders.
Yeah, I mean, I think that's a long-term point of view that shareholders won't invest,
Yeah.
but the question is, how much of a role should those decisions have in the final decisions that are made by a board of a public company? How much should environmental, social, governance? Certainly, I think they should be factors, because being a good corporate citizen generally leads to better business
Right.
or contracts, but not using any carbon fuels at all, do we have to go that far to be a good corporate citizen? I think it's a complex set of observations, thoughts. Different companies are going to come out differently, but again, like with crypto, I think we need a rule book, and that's going to take 10 years to develop that rule book.
So I want to thank Dual for coming, Dual Glass. Dual has a question. What's on your mind, Dual?
I'm curious about your thoughts on investments in the energy space, oil and gas exploration. And I thought I'd just mention a couple of things coming from the energy world. And I think there's a lot of misconception in the ESG definition, because in the oil and gas industry, ESG has been a focus for many, many years, with concern for the environment, social and governance issues. And I'm really concerned. I brought this up in front of some large institutional investors, how their misguided ESG policies have thrown a lot of people into energy poverty around the world, because there's a lack of capital in the oil and gas industry. And what limited capital there is now, much of it from mandates, is going back to dividends, stock buybacks, and to pay down debt, which and less is going into exploration and production. So I think we're going to have higher prices for some time. But I wanted to get your comments on that, and also the comments of all the people that are being thrown into energy poverty around the world because of these misguided allocations of capital away from the energy industry, rather than focusing on maybe carbon sequestration and some other things that industry is certainly competent and capable of doing. And it's kind of ironic that in many countries in Europe, they're cutting down trees and burning them for heat. And anyway, just a few thoughts.
I mean, I don't think it's an answer to the question. I think we're not ready to move away from carbon-based fuels. That, I think, is a fact. I think the second factor is a free rider problem with countries that are moving away from carbon fuels, because you have other countries still burning coal. I was in Beijing before COVID. Everybody wears a mask. It wasn't because of COVID. It was because there's a lot of sulfur floating in the air there, and your eyes burn. It wasn't affecting my son. Couldn't believe that people would walk around there. So you have some countries doing that, while we're trying to spend a lot of money in technology and developing water, power, air, wind, nuclear, solar, et cetera, et cetera. It's a very complex issue, but I don't think it should be a political issue, is my point. I think it should be a sound economic set of decisions on allocating enough resources. I mean, I have an electric car. I drove to Jacksonville, actually to near Jacksonville. I could not charge the car. There was nowhere to charge the car. There were no fast chargers. I wound up having to stay overnight. And fortunately, the hotel had a slow charger, So by the time I got in the morning, I was 40% charged and I could make it back. So that system's not ready for prime time, no matter what they tell you. That's a good investment, in my opinion, of federal dollars or federal and private dollars, because we should have a better electric grid. That's not going to solve the problem either, because there's only 5% of cars are going to be are electric now, and we'll get to 10% in the next 5 to 7 years. But I think it's a slow evolving process. It should not be a political process, it should be an economic process, but now it's a political process.
So I had a person share a script with me about 8 years ago on how they were going to change the world through proxy voting, right? And basically, it sounded like very similar to like maybe Al Sharpton or Jesse Jackson shaking down a big corporation, right? So they realized, hey, we can change companies' thoughts and philosophies and their budgets based on, um, you know, putting pressure with regards to communications on them and the actions and how they look at labor and where they source products from and exploiting the communication. And I mean, you can see it sort of going on with Apple today. Jeremy was telling me earlier this week that Elon Musk is in a little dispute with Apple regarding the App Store and them taking 30% of the revenue from all the developers, and then threatening them to kick them off and doing some things like he was doing to Twitter earlier this week. So, you know, the philosophies are idealistic, but I think some of the motives have nothing to do with economics, right? Would you say that's
Yeah.
fair?
I do. I think a lot of the social part of ESG is politically driven by interest groups. And it's an easy thing to do. I mean, you can point to X and say, and the thing is, how do you measure ESG? If you're very conscious of the environment, but you do 2 or 3 things that are not, are you ESG or are you partially ESG? There's no scale to measure that on, you know? And again, that's what a rule book does, right? You set parameters and you say, these 10 things amount to an A, these 10 things amount to a B. But we haven't done that. Instead, we came up with a philosophy and we didn't have any fundamental underpinning rules for that philosophy. How are you supposed to act? What's a good ESG system? What's an okay ESG system? And I really analogize it very much to crypto. We came up with an idea of a worldwide currency that didn't require government printing and would be self-regulating and secure. We're nowhere near that, but where's the rule book? We know there's no rule book because we just saw that the exchange that was trading that didn't have any rules.
So if we listen to Rob wants us to come up with the rule book, but I don't think that's going to happen during this session today.
Not today.
We have another presentation coming up, Valley. I know we're a couple of minutes over. We got started a few minutes late. So we're going to, for those of you that are tuned in virtually, we're going to be running a few minutes late for the next presentation. I don't want to sit here and beat up on crypto after I lost so much money. I want to slice my own wrists. Don't take that seriously and report me to any authorities. I'm not going to harm myself, I promise you. But I was very depressed at losing that money. It wasn't fun. It's never pleasurable. No matter how many times you go through it, it's quite painful, right? I'm not talking about from an ego perspective, but I'm just talking about, like, you know, all these great ideas failed. No matter how much I knew or how much I tried to de-risk the strategy legging in, and it's terrible what happened in the crypto space. But going back to macroeconomics, because that's what a large part of this event has been about. You said that, like, inflation, higher asset prices was mainly driven by wealth creation. Right?
And the increase in the money supply through what the government did through PPP, buybacks, bonds, et cetera, et cetera.
So it was the largest ever event, or it was the largest event of wealth creation in 50 years. The U.S. consumer is stronger than it's been in the past 50 years. What is the downside? What's the downside looking out over the next 12 months? And then how do you position a portfolio? How do you position yourself today? How do you invest your money right now today? You started talking about debt. It sounded like you were going a little listed debt. Are you also going private debt?
Yes.
But what are your thoughts today on
I think that's going to be, it sounds stodgy and whatever that term they use to describe people who believe in traditional finance.
TradFi?
TradFi. I think it's very TradFi.
I
But
gave the
I
proper
do think
citation, by the way.
getting
Just-
8 to 15% through corporates, a little bit high yield, and then private debt is going to be a very good investment strategy going forward. No more 60-40, but focusing on debt in a higher interest rate environment that I think is at least semi-permanent. We're not going back to zero. That was a fundamental mistake. And then I think rates will hover around that, depending upon other factors. I also think the next big,
What happens if inflation doesn't back down?
then it'll be better to wait and do more debt. But I also think the other big trend that we haven't talked about at all here is, when does China do QE? China cannot, its economy its stock market is so small now. I mean, as you know, I invested in a very levered Chinese portfolio a year ago, when everyone on Wall Street said the only screaming buy is China. China is down more than our depression in the last 2 years. And their market is so small now, the stock market, that if you take 2 or 3 U.S. listed companies, it's more than the entire Chinese market. So you have stocks selling at 4 to 6 times earnings on average. And this is a reaction to the political system there, to their COVID rules. But soon, I don't know what soon means, but soon, the Chinese are going to flip that. And they're going to put $1 trillion of money into their system. They're going to buy back bonds. They're going to lower rates. They're going to do government spending. And money's going to flow into China. So I think the next big macro thing that's going to happen is money flows into China and the Chinese market starts reinflating. Because if it stays like it is now, the Chinese economy will grow at 1%, not 3%. And I met with Chinese officials. I met a lot of people when I was in China teaching. And it's not something they're comfortable doing because they see it as sort of like a 100-year project, not a 3-year project. And they said to us, you see everything as the next quarter. We see everything as the next quarter century.
Give us some examples of debt that you're looking at, both listed as well as private debt deals that you've been.
I'm much more on the private debt deal side because it's a less efficient market. The deals can be underwritten at better prices because there aren't as many players. I mean, everybody wants to own traditional
Are you
corporate
still
debt.
doing like cannabis and stuff like
Cannabis
that?
is great. I mean,
What about
it's possible that the federal
psychedelics?
government will come to, I don't know now, depending if they don't get it done before the Republicans take the House, they may have a federal bill that will legalize banking at the federal level. That would not eliminate but reduce substantially the cannabis, but I don't think that's going to happen. So cannabis will still be low double digits with good collateral.
So you're talking about real estate on cannabis companies, like
Real
grow
estate on cannabis
facilities,
companies,
stuff
correct,
like that,
correct.
the debt on.
But
on
we're a country of small businesses.
what is that
bank-
getting today? What is that yielding? Those types of deals?
The cannabis deals?
Yeah,
12 to 13.
12 to 13 with
Yeah.
real estate, commercial real estate
Correct.
backing up the debt.
Yep.
Okay.
I mean, I just got bought out of 14% debt.
Are you doing any floaters that like go up in a higher inflation environment just as a hedge?
I mean, some of the middle market debt is floating rate. It was floating rate, so it continues to be floating rate. But when you're doing alts in the middle market lending space, the deals are sui generis. They're unique. You know, I just did a deal. It's a 17% with an equity kicker. I'll count the 17% they think is a 30 IRR. They're financing in barrel bourbon. Okay, so they're buying the bourbon when it's made. It's not sold for a few years. They own it. They can put it back to the company at an 18% yield, or they can sell it themselves.
Is it like niche crafts or is it high volume?
This is
brands?
I wouldn't say niche, but it's not the $12 bottle.
Okay.
It's the $60 to $70 bottle.
Is it based in Bend, Oregon, or the U.S.?
Kentucky?
In Kentucky. So, all right, so we talked about that. We talked about macroeconomic risk. Where is the upside other than inside of like clipping coupons, which is possibly
What's
the
wrong with
most-
that?
The most
We-
boring thing.
People did that for 20 years and were very happy.
I think crypto is more fun than that, don't you?
No.
It was like going to the Hard Rock, you know?
The million people that had their money at FTX don't agree with you.
They did last year. They did last year.
Well, I would just say the irony of all of this fallout. The irony of the fallout is it was going through a centralized, right? It's the TradFi way because it's whereas the salient feature of Bitcoin is be your own bank. The idea of having transactions done without having to trust your counterparty. I mean, it's just kind of really ironic that by going through the exchange and by wanting institutional adoption and for there to be a third-party custodial solution where you have to place your trust somewhere else. And then this is how people can take off with your money, right? So
Well, if you're going to have lending, which they did, you have to have a third-party custodian.
Right.
Somebody has to
so
account for the lending and determine the rates and do that transaction.
yeah, I just don't know how to reconcile the promise of decentralization and then wanting centralization to happen as a result of reducing the friction and having that efficiency. So there's a weird trade-off, but FTX is a perfect example of why you can't necessarily trust your bank, not even in your own bank account, right? Because at one point in 2008, I think there was a run on some of these banks, and there was a chance that you were going to lose your deposit or whatever you had in these banks. So I don't know.
So, Andrea, it's always good to see you. I love your sunglasses today. They look great on you. With regards to like the parallels between the crypto and the U.S. banking system or the global banking system, I personally feel that you have something that's built on transparency that's not very transparent, right? And when you see the sophistication of some of the people that were investing billions of dollars into these companies, it just makes me think it was play money to them.
Oh, no, there's no doubt about it, but there was also this rumor out there that this is a play on forcing the hands of the regulators to finally come up with some sort of regulations, because it's a bit of a chicken or the egg situation. Everyone's saying, like, there are no rules around it. That's because there was no clarity the way we did. Oh, sorry. For instance, Switzerland had, the tiered regulations around crypto, so it was easier to navigate around it. But in the US, anyway, it's just really interesting. I think there's a lot more than meets the eye in this situation, and we're about to, find out.
So one of the comments I want to get back to that Rick made earlier today was about private equity mockdowns at 50%. So one of the observations being involved in the financial crisis and in 2006, 7, 8, 9, and really digging into the framework, the structure of our banking system at that time, I saw what was happening that happened. And I couldn't help but to think it's the same system. It's just we moved the way that we disclose things, and it created a buffer for things like mockdowns, right? Like write-downs, right? So at first, everything's inside of these publicly traded banks, right? And people could go and vote on the day, should Bear Stearns be alive or dead? If the word was dead, the stock would be down 80%, right? Like that. It was happening to General Electric. It was starting to happen to pure financial institutions. So why did it take so long, almost 3 years, for these write-downs to come? And are we going to be able to process these losses and move on like from here and like heal as a financial system?
I mean, I phrase it differently. I don't like I say, use my example, why aren't more people jumping? I went through a list of 10 companies, $1 trillion market loss. There's another 100, it's probably $5 trillion market loss, $1 trillion or more in crypto. And then the private equity losses, we don't know yet. So why isn't there more of a, 2008, I was teaching law school and all the students said, we don't trust banks. We'll never trust banks. We're going to be anti the banking system forever. And that was the, so this is so much greater. Okay. 2008, remember, there was an issue of liquidity also. Banks couldn't raise money and they couldn't borrow against their debt. But in the end, Lehman Brothers failed. All the Lehman Brothers customers' securities were paid out. They had SEG. Nobody let the equity holders lost money, but the people who had money there in brokerage accounts all got paid. That's not going to happen with FTX. So that should cause people to have a worse feeling towards crypto in the exchange than they did towards brokerage. But with the amount of loss across the market, bonds 15 to 17, private equity 50, zombie companies, why isn't there more people saying, holy cow, this is crazy stuff? The answer is the $7 trillion lollipop is pushing people's horizon out. People still have money to spend because they've been given all that free money. You and I both know lots of people. There was an article yesterday about fraud in the PPP program. It's like there was an article yesterday about people breathing oxygen. You know, that like it was the most fraudulent thing I've ever seen as a fraud lawyer in my life. And they're now talking about how people who had no employees were getting $60,000 loans, and people were getting repeat loans when they shouldn't have got repeat loans. And
I think 60 is a low number, to be honest with you.
right, but a lot.
That's not a Miami number.
That's not a Miami
Miami numbers are 500K.
Right.
You know, like multiple companies. You know
But
what I mean?
people were
We got
calling me
some of those
bragging
circulating
about
over
saying
there.
I've never had an employee. I've run my own business. I just got $60,000. Like, don't tell me that on the phone, and I don't know who you are. You know. But yeah, so it was endemic fraud, but the money still went out. So all of this is getting delayed. I don't think we've seen nearly the last shoe drop in
All right,
terms
so
of
was it
what's going to
right-
happen when all of this loss gets recognized.
So was it right to put these shock absorbers, which is private equity, in place to protect traditional depository institutions, going back to Andrea's question? And when will these write-downs that you're talking about, when will they occur? Like, what's the timeline on them?
Within the next 12 to 14 months. But again, I asked a different question. Why aren't people more angry at, I will name one name, Chase Coleman? Okay? The king of private equity had to do a private equity deal a day or he couldn't go to sleep, apparently. Hired third parties to do all the due diligence. So you weren't even getting his acumen, you were getting McKinsey or somebody else. Put more money to work than anyone else. And now he's down 50%. Why aren't people saying, what the heck? How did this happen?
For those of you that don't know Chase Coleman, Chase Coleman is what, Tiger?
Tiger. And he bought $100 million house in Palm Beach. $100 million.
He was making like 40 billion or something. Like his paycheck. 4 billion.
The crypto industry is distracted.
So crypto is distracted, hedge funds are distracted, private equity is distracted, private debt, it sounds like, is a bright spot.
I think going forward, it'll be a bright spot.
All right. So, do you have any thought of U.S. equity versus international companies? It sounds like you're very bullish on China. Is this a emerging market play? Is this just a China play? Is it an India play? Like, is it just limited and contained to China? Or
I'm not experts in those markets, but China has to come back. If the world economy is coming back, and they will, it's just they've made political mistakes. You know, from our perspective, they're overdoing it on COVID. From their perspective, they're not. Again, that's not an economic decision. That's a policy of social, cohesion over there. But there's going to come a point, and it's not that far off, where they're going to say, okay, COVID's under control, opening up the economy, here's $3 trillion to spend, and the stock market's going to go up 100%.
so we're actually way over time. But we have one comment from Dual. Dual, flew in specially for today's event.
For this comment? No.
So,
No
a couple
pressure.
of comments. One is
Pressure.
about the accounting standards and government manipulation in China. And I guess you could utilize the United States in that, questions about that in the United States as well, but particularly China, in light of quite a few manipulations. And the other comment is about inflation. And what we think is low inflation is really quite high inflation, particularly when you look at including taxation and inflation with respect to bond returns and some of the challenges in credit. So I just wanted to throw that out there and get some feedback on those two items.
What was the first one again? I got the second one.
The playbook in China with respect to accounting and
Oh,
and
yeah,
standards
I mean,
and also government manipulation in these companies.
the SEC is pretty close to agreeing with China on mutually acceptable accounting standards. The issue with China isn't so much frauds. There were some colossal frauds, but there are much more colossal frauds in the U.S. I mean, there's 270 securities class actions every year. We're the ones with Enron. We're the ones with Adelphia. We're the ones with Madoff. Yes, there are frauds in China, but they're pretty close on accounting standards. They do not want to close off the Chinese market. In terms of inflation, yes, I do think it's more, the effective inflation is higher than it's being recorded, in my opinion. And I think it's more obvious to people of lower income than higher income. And I'm not sure that it's really coming down at all. We may just be in this environment where inflation's a little bit higher, rates stay at this sort of like 5, 6, 7 range for quite a long period of time. And absent free money, it's a very different system, right? Absent being able to kick the can down the road, you have to really come up with really crafty schemes to raise money for companies that are zombie companies. And I described some of them to you today. But again, I leave with one final comment. I know we're done. Is I don't feel people are outraged at what happened. If private equity is down 50% on average, that was the biggest money-making enterprise of all the investment vehicles out there. Those people weren't just investors. They were superstars. They were on TV. They had football stadiums named after them. And they were wrong by 50%. That's upsetting. But people don't seem to be that upset.
So with that said, we're going to conclude this session today. Before we do, I want to encourage you to check out Rick's group, PBIRG, Palm Beach Investment Research Group. He gets together twice a month, and he brings together a bunch of family offices from the Palm Beach area to talk about alternative investment opportunities. And he's got an excellent group. They've been very, very active, and what they do is they like crowd source each other's research on ideas.
But everybody makes their own decisions, so there's no group decision making.
That's not a hedge clause.
No, you'll sign the hedge clause when you come. Don't worry.
Thank you for
Thank you.
coming. It's always interesting and great to have you.